Let's bring in Max Wasserman, founder and senior portfolio manager at Miramar Capital. A guy looking for quality stocks. Maybe one could call them value at times. Good to see you again, Max. I'm guessing ARM Holdings at 100 times doesn't exactly fit your bill?
It's great to see you, Oliver, and I love your commentary on ARM.
Thanks.
The rationality seems to go out the window right now. At 100 times earnings, the debt level at 10% float, the market right now, this is a gamble, the short term for this company with ARM. I mean, long term, who knows? But it's very rich, and it's a comment on the market today. The market seems to be ignoring inflationary indicators. You mentioned that earlier. It seems to be ignoring multiples on the market. But yeah, so we're going to stay in our knitting to look for quality dividend growth stocks, a value to growth bent, if you will.
The ground seems less fertile than it would have been even a couple months ago. I mean, especially given what we've seen here for some of those inflationary indicators, dollar moving up, rates moving up, crude oil breaking out. I mean, to drop a bunch of supply onto the market, because that's essentially what this is, right? It's just $50 billion of new potential stock one could buy instead of an Nvidia, instead of Apple or whatever.
Yeah, you think you might get a reallocation, actually. You may see people pull money from the large cap growth stocks that have worked and have run up so much, and they may chase this as a bet. And you may see a reallocation for the short-term traders. It's really hard to tell with these things. I mean, I think your previous guest mentioned it could go to 70, 80. Who knows? Rationality seems to always go out when the hype is this big. That being said, it's only a 10% float, keep in mind. SoftBank's keeping 90% of the company. And how many people think he may have to get more financing? I don't know. But with inflation out there, and if the Fed's going to be true, if it's going to be true on its target, indications are the Fed should still be raising a quarter to 50 basis points.
Such an important way you frame that. That's exactly what I was talking about this morning, which is if the Fed is true to its word about 2%. And do you think the market is implying right now that maybe they disbelieve the Fed's conviction? Because again, if they're actually gets 2% and now we're seeing inflation not just plateau but warm up, that tells us that gravity's work is done for the moment, which would imply the Fed has to apply some force.
I think part of this market, and I say part of it because it's not the general market, but part of this market is living in denial, in our opinion. If the Fed's going to stay true, we are seeing signs that inflation is still strong, core inflation. You still see the energy prices, you still see food prices, you still see consumer spending. And if the Fed's going to raise interest rates a quarter to 50, tighten it. If interest rates are going to remain higher longer, and keep in mind, people are saying that, but they're not acting like it. So this market has, at these multiples, at 20 times forward earnings in the S&P, a NASDAQ that's up 31% for the year. It's discounting a lot of optimism. And if the Fed were to actually do what it's saying it's going to do, I think it could be on weak ground, if you would.
Okay. What works for you? I mean, I know that some of the quality and value stuff you like has been benefiting from the rally, right? I mean, like you've always been an Apple guy for the most part.
Right.
What is appealing to you at this point?
Well, that's a great question. Last year on a relative basis, we had a really strong year being in dividend growth. I mean, we were down substantially less, around 5 to 6% in our portfolios. This year, we're just sitting on the sidelines, it seems like. We're not really moving that much. We do have an Apple, we do have a Broadcom, we do have a Microsoft, are some of our biggest holdings. But right here, I don't see too much upside in the next 6 months on these stocks because of the valuations. So we're trying to find other areas of the market that haven't moved. So we still like healthcare, and we like the medical suppliers. We like the Medtronics. It's paying about 3.1%. We think as people go back and do more procedures, a company like this should benefit where it wasn't benefiting before. It also has some cost pressures and supply chain, but a company is paying about 3.1, 3.2 dividend, and it should benefit as people have more procedures and hospitals open up. We like that. We still like the specialties, some of the specialty finance, like a CME Group, which is the largest futures exchange, which should benefit from more volatility and interest rate changes. So that area we like, and we still like BlackRock. It's giving you about a 3% dividend yield, close to it, 10% dividend growth. And we think it's a very good technology way to play asset management, if you will. And they have the largest ETF iShares there are. But again, that's where we have some investments. We also like some of the defense stocks, like General Dynamics and Lockheed. We like that area because we still think the world is pretty unsafe and the demand's going to be there. But the market right now is really focused on the NASDAQ. And if you go back to 121, if you will, go back a year and a half, 2 years, the market is still down in the NASDAQ. It's still down on an equal weighted basis. Even though everything's run up this year, it's so concentrated in the NASDAQ that any hiccup, any raise in rates, any continual tightening, any balance sheet tightening, which really you haven't seen that much, is a problem for these type of valuations. And keep in mind, we still have not seen this infrastructure money hit the market. So I don't know how the Fed doesn't react to another quarter of 50. And again, you do one or two, it's not going to end the world, but it does signal that we're staying higher longer, and inflation is still an issue. So I think it's up to the Fed to do what it says it's going to do. But all indications out there from the numbers we've seen today, yesterday, is that core inflation is still there and it's still sticky.
One observation, correct me if I'm wrong, Max, it seems like the stocks that you do want to be in, the defense, the medical devices, there's almost kind of like an essential service or product component to it. It doesn't sound like you're getting too much tied to like discretionary consumer spending. Perhaps there's other stuff that, I don't know about, but is that a fair description?
I think so. I mean, we do have some specialty, what we consider specialty. We still like the Starbucks in there.
Okay.
We still have a McDonald's, those type of companies, and a Home Depot.
Kind of staply.
Yes. Yeah. But I think what you see is right now the consumer's stretched, as you know. Consumer debt is high. Interest rates on these credit cards are in the mid-20s. So you're starting to see them going to eventually run out of money. And you're seeing inflation in rental costs for apartments. You're seeing food. So we see a consumer that even though it's spending on services and experiences and less, we think that's going to also change because they're going to be trading down even more because we do see the economy slowing down, but you still see interest rates high. And I do not understand, again, I'm perplexed. I have to admit to you how this market keeps shrugging off all the information, the strong dollar, what's happening overseas, what's happening with inflation. I just don't see how they seem to ignore this.
All right. Great to catch up, Max. Thanks a lot for the analysis. Little thought on ARM, too. So we appreciate that. Timely discussion.
Thanks a lot, Oliver. Great seeing you.
Yeah, likewise. Have a good one. Max Wasserman, founder and senior portfolio manager at Miramar Capital.